That is so ironic. I spent a bunch of time over the weekend putting some notes together for my video this morning, which is talking about the risk that the markets are at right now, the risks of the markets tanking. Well, what happened this morning? The markets right out of the gate, of course, tanked. Now, every time the markets hit the all-time highs that we've been seeing, people ask the same question: how much higher can it go? Well, here's the thing. History will show us that the markets do not stay overheated forever. They never have and they never will. So with what we're seeing this morning, we're seeing a dip, perhaps a buying opportunity, or is this just the calm before the storm? Let's take a closer look. Now, good chance that you've seen this chart. It's the CAPE chart, cyclically adjusted price to earnings ratio. It is a valuation metric. Today, it's sitting at 38.47. And you can see back over time, it's rarely been this high. This chart, for context, goes back to 1871. So it's a legitimate measurement of what's been happening. Very, very few times has the ratio been so high. Now, obviously, the stock market has been on a run. We've seen the major indices, the S&P 500, the Nasdaq, the Dow Jones, the TSX, they're all have been pushing to new highs. What you're looking at here is a 5-year chart. No doubt it's quite impressive. As exciting as these gains are, though, the question remains right now, how sustainable are the gains that we've seen? Today, we're going to look past that CAPE chart. You're going to see a lot of that. We're going to look past that. We're going to analyze these markets through another lens of valuation using standard deviation as our key measure. This approach will help us understand how far the indices have strayed from their historical norms, whether we should be concerned about an eventual correction. The bullish momentum we've seen now has been strong, but the markets never stay overvalued forever. They always revert to the mean. So let's dive into the data and we'll see what this tells us about the risks and the opportunities that lie ahead. First off, for those of you who aren't sure, what is standard deviation? Well, standard deviation is a statistical measure. It shows how much a market deviates from its historical average or mean, and it helps an investor gauge whether a market is overvalued, fairly valued, or undervalued. Now, one way you can look at this is like a rubber band. When it stretches too far from its average or the mean, it eventually is going to snap back, and that is exactly what standard deviation measures, how stretched the market is when you compare it to its normal range. Now, how do you interpret it? Well, if the mean is 0 standard deviations, that is the historical average price for the index. If it is +1 standard deviation, it's moderately above average, but it's still within what we would call probably a normal trading range. Now, when they get to 2 standard deviations, this now means that they are significantly above historic norms. This often will signal an overvaluation, and we're at a risk of a connection. If it is -1 or 2 standard deviations below the norms, that typically would suggest undervaluation and potential opportunity. So as an investor, this is how you would apply it. When markets are trading above 2 standard deviations, they're at historically high valuations, and we saw that with that CAPE chart. It can mean that the risk of a correction, or at a minimum reduced returns going forward, is definitely elevated. When markets are closer to the mean or certainly below the trend, they tend to offer better long-term investment opportunities. As always, investors should balance their risk and reward by considering how far an index has moved from its historical trend. If we use history as a little bit of a guide, we don't have to go back that far to learn some real lessons here. A couple of examples I'll give you here, starting with the dot-com bubbles. Well, in the late 1990s, the stock market, and especially the tech-heavy Nasdaq, was on quite a run then. And at the time, investors were very excited about the potential of internet-based companies. It was still pretty new back then, and this led to a pretty significant rise in stock prices. Now, I will recognize that a lot of you watching this video weren't investing then. Probably some of you weren't even alive, but that doesn't mean that you can't learn from what actually happened. Now, during that time period, the Nasdaq went to levels that were way above its historical mean, and the valuation metrics went to well above their long-term trends as well. The other indices all did the same thing. Important part here, what happened? Well, in March 2000, the bubble burst and the Nasdaq fell nearly 80%. All of the indices went along for the ride. You can kind of see by these charts here what happened. The Nasdaq fell the most, but they all fell. The S&P, for example, declined by about 50% from its peak in 2000 through to the trough in 2002. So the lesson here is that when markets detach from the fundamental, reality eventually catches up, and we may be seeing that right now. Second example here, A little bit more recent, the housing bubble and the financial crisis. So I'm going to call this mid-2000s. Leading up to 2008, the U.S. housing market boomed. The financial markets, including the major indices like the S&P 500, the Dow Jones, they again reached new highs. Sound familiar? That's what we're seeing right now. In this occasion, the growth was fueled mostly by the easy credit conditions we saw, and there was a lot of speculative investments. Well, by 2007, the S&P 500 was trading at levels approximately 2 standard deviations above its historical mean. What does that mean? Well, as I said, it is an indication of a significantly overvalued market. Does that sound familiar? Well, that's where we are today. The outcome was the financial crisis led to the big market sell-off. We talk about that even now. All the majors fell. As an example, the S&P 500 from its peak in 2007 to its trough in March 2009 fell by about 57%. So the key takeaways here is this mean reversion tendency. Historically, when major indices trade at levels that are significantly above their historical mean, so for example, 2 standard deviations or more, they have been substantial corrections, and the reversion to their long-term trend has always occurred. So as for your risk awareness, these elevated valuations that we're seeing today, they absolutely can go on for an extended period of time, but you're often going to see them before we see these significant market downturns. So investors during times like this should be cautious at a minimum, and they need to recognize that there is an increased risk of a market correction here. So all that said, where are we today? This is probably the crux of the video today. Well, let's look first at the S&P 500. The current level of the S&P 500 is 6101. The mean level, 3,381.98. 2 standard deviation levels above mean is 5,575. So you can see already the S&P 500 is trading well above the 2 standard deviation level. So that indicates to me that there is an extreme level of overvaluation. Again, historically, the sustained moves beyond 2 standard deviations are rare. They're often followed by corrections back towards that mean. Now, the current level is nearly 80% above that historical mean. And to me, that just means that the markets have run way ahead of what the fundamentals say they should be priced at. So as an investor, what do you need to know? Well, the risk-reward balance here is very unfavorable. Future returns will likely be lower from the levels that we're at today. If we see a mean reversion, that could imply a decline potentially as much as 44%. Now, investors should at least consider taking profits, maybe rebalancing your portfolios, or adapting a more defensive strategy. Now, a reminder here, I can't advise you directly. I can share my thoughts here, but I don't know about your circumstances. I'm just sharing some experiences that I've had over the years as an investment advisor when we've been through times like this before, because some of you may not have been here before. Now, second example, the Nasdaq 100. The current level of the Nasdaq, 21,774. The mean, 10,112. So these 2 standard deviation level, 19,849. So again, the Nasdaq far exceeds even the 2 standard deviation level. So that makes it the most overextended major index that we're looking at here today. It is trading at 115% above its mean. And so that to me, again, says that we have an extreme valuation there. Now, when we have seen extensions that are historically overvalued like this, they have preceded significant market pullbacks. Example, like we looked at the 2000 tech bubble. Now, as an investor, when you look at the sharp history of these corrections, right now, when I look at the 4 indices I'm looking at here, the Nasdaq definitely carries the highest downside risk. A reversion to the mean would mean a decline of more than 50%, and that is a massive potential drawdown. It is true that momentum traders might continue to benefit from this, but long-term investors should probably exercise some caution here. Dow Jones Industrial Average, where are we now? 44,424. The mean there, 27,853, and the 2 standard deviation level, 42,563. So again, the Dow is also trading above that 2 standard deviation level. That is signaling to me a clear overvaluation. The current level is nearly 60% above the historical mean, and that makes the case for a strong reversion back to that mean. Now, unlike the Nasdaq, the Dow has a bit more stable composition, but if we look at history as a guide here, it still suggests that corrections from this level are more likely than not. Now, as an investor, the implications for you here, like I say, the Dow isn't as stretched as the Nasdaq, but we're still way above the normal value, and so that would suggest at a minimum lower future returns. If we move back to the even 1 standard deviation above, that would be 21% correction from now, while a full reversion to the mean would decline about 37%. So Investors, if you're managing your portfolio, you might want to consider diversifying your portfolio to make sure that you're still staying within some companies that have some better valuation metrics. Now, the last index I want to look at today is the TSX. We're trading at a current level of 25,490, and two standard deviations above mean is 23,605. Like the other industries we're looking at here, we're trading at above two standard deviations, not quite as severely stretched as the S&P 500 or the Nasdaq, but we're still about 45% above the historical mean. And like I've said, that suggests that we could have a significant overvaluation situation here. This implies a pullback to even one standard deviation would drop about 18%. A full reversion would result in a decline of about 31%. So investors in Canadian equities, like the other ones, you should consider taking some profits, balancing your portfolio, taking a more defensive stance, all those types of things. So in aggregate, what do I see here? Well, all of the major indices, so the S&P 500, the Nasdaq, the Dow, the TSX, are all currently trading above two standard deviations. That indicates across the board that there's extreme overvaluation when you compare that to the historical norms. The Nasdaq 100 is the most stretched, so that makes it particularly vulnerable for a major correction. The S&P 500, the Dow Jones, again, they're both significantly overextended. Valuations are way past the peaks that led to previous corrections such as 2000 and 2008. The TSX, also above two standard deviations, not as severely stretched as the US indices. That means that the risk level is slightly lower, but it's still definitely elevated. So a reversion to the mean here in any of these, probably they'll all act in tandem here, that would result in significant drawdowns, anywhere ranging from about 30% to 50%, depending on the index. So what's the big takeaway here? Well, markets are clearly stretched. They're trading at levels that historically we haven't seen very often, and we know that they don't last forever. If there's one thing that history teaches us, it's that the markets will always revert to the mean. It's just a matter of when and how violently that will occur. For investors, it means lower future returns. If you're buying at these elevated levels, don't expect the same kind of returns that we've seen in recent years. The higher we go, the harder it gets to keep climbing. Be smart about risk. If you are sitting on big gains, it might be a good time to rebalance, to take some profits, or at a minimum, have a game plan. If things turn south, opportunities will come. If the market does correct, that's not a bad thing. Like I say, it is a chance to buy some quality assets at better valuations. As always, in this case, patience will pay off. At the end of the day, bull markets don't last forever, but neither do bear markets. The key is to stay informed, stay balanced, and stay ready for whatever happens next. The real question is, are you ready for what's coming next? Let me know what your thoughts are in the comments. As always, thank you for watching. We'll see you in the next video.